Slice the Podcast is brought to you by VegaLend, a different way to get a mortgage. VegaLend provides insight and advice so you can make informed decisions for the future of your family. Welcome to Slice, property made possible. We're a platform on a mission to reduce barriers to home ownership. This podcast is a safe space for our community to learn together and build the confidence required to start on their property journey. When you're ready to start, head along to slicetobuy.com and sign up for your free dashboard.
Salam, Amy.
Kia ora, Deej.
Oh, like that.
Yeah.
Like that. Straight into it. So today we're talking about the bank of mum and dad. Apparently the fifth biggest bank of Australia and New Zealand.
The fifth, Deej. They're
Yeah,
a
where'd you get that fact?
wealthy little segment. I keep those facts just tucked close to my chest there.
In your back pocket. Love that. Love to hear it. So the first thing we're going to be talking about today is what we call limited guarantee, which is something you did with your mum.
Yeah, so I've mentioned it kind of at a high level in a couple of other episodes,
You have.
but we'll crack into that in some detail, and I probably will just talk about how mum and I did it so that it's more kind of
That's what we're here for.
easier to understand.
How does it work?
Yeah, so I had 40k and then I leveraged against my mum's house. So she had a freehold house, and if you do, you are actually able to guarantee someone else's loan. And there are two types of guarantees. There's a guarantee in general, and then there's a limited guarantee. A general guarantee means that if you fail to make repayments, your bank can actually demand those repayments from the guarantor, i.e. my mum, or they can actually force sale of that house. And if it's general, it's up to the entire value of the house. If it's limited to a certain amount. So for example, it was somewhere around 100k, our guarantee with my mum. And so it was limited to that amount, which is your ideal result, because you obviously don't want to have the bank have that access to, the entire value of that house.
Exactly.
If it's $1
Pretty
million
risky.
or whatever, yeah.
Pretty
So
risky.
if you can, lean into that kind of limited guarantee. But for the most part, it just means that you can get into property sooner without having the deposit, where you have, the good kind of earnings that you require to make the repayments. So your ability to service the loan. You need to make sure that you're comfortable there, which I was. But it's a really easy way to get in if you have someone and you're lucky enough to have someone willing to do that. And it obviously does not come without its risk, but it does, present an opportunity. And I think I've spoken before about how hard my mum actually worked to get back on the property ladder. So it wasn't something that we took lightly, and we did go through the legals and
Risk analysis.
Yeah, we had a lot of conversations back and forth, and in the end, I had to really present a case as to how it might be of benefit to her as well and to me. Obviously, she wanted to help me in, but she's worked so hard, and it is taking on an amount of risk with any type of investment. And generally the person taking that risk on would receive some benefit. So, if you're lucky enough to receive just straight out cash from a family member because they have that lying around, that's amazing. Some people do have it, dude. And that's, that's awesome. But if you don't, this is another great option, but you have to understand the risks and you have to work through that together. And so I think later in this podcast, we'll talk a little bit about the benefits for the other party if someone is helping you into property.
Yeah, which is, I'm keen to hear a bit more about that.
Yeah, sometimes you have to incentivize,
Two-way street, right?
Yeah, definitely.
Yeah.
But yeah, I guess the key things about guarantees are they're great in that you don't actually have to have any cash to put up. You can just leverage the property that you've already got to purchase another one, provided, you can service it. If you are going to do that, though, definitely you'll be required to get legal advice. The bank actually requires that for both parties. So my mum had to get independent kind of advice and support, and she wanted that as well.
Not just your advice.
Not just my advice, which is a really tricky one to navigate.
One wanting the money.
Well, yeah, it's a tricky one to navigate, though, because my mum does trust, we've got a really high trust relationship, and
great.
she would sometimes want me to answer questions or explain things to her. But that kind of dynamic I was really cautious about, because I didn't want to be the one advising her when I'm the one who's going to benefit.
Yeah.
So I actually had to say, oh, look, I don't feel comfortable kind of giving you some information on that one. Like if it was objective information and factual, then I'd share it. But I sort of had to say, well, this is what the benefit could be for you, and this is what the benefit is for me, which is obvious.
Yeah.
But I would kind of try and present something that was appealing to her without kind of feeling like I was pushing her into it, because the last thing I wanted is her to feel like I'd pressured her or something like that. And the other thing is, my mum had actually always thought of doing it. Like I remember being 18, and I wish we did it back then now, and walking through houses and her considering going again. So it had also been, there'd been an element of her thinking about that for a long time.
That's awesome.
And then we were able to do it together, and I was readily able to service it, and she didn't have to pay for anything else. So I was then able to remove that guarantee after a year, meaning her house is no longer at risk. Although in saying that, a really sticky one that the banks do, and this is just a word for the wise, is they remove the guarantee and then they maintain the right to kind of still act within the guarantee for another 2 years after that. It's different at each bank, but there are little loopholes like that you need to just be aware of and make sure that your finances are going to be able to maintain that,
I didn't even
over that period of time.
Yeah,
it was a bit of a stitch up of an experience, but because you think you release the guarantee, you release the guarantee, but yeah, I guess you want that guarantee removed as quick as possible, because for as long as that guarantee is in place, the bank has the ability to claim, money up to that limited value or up to the entire value of the house, or force sale of that house if you fail to make payment. So there is some gnarly risk involved.
Yes.
But also, if you can find a way to do it, people do it all the time. And if you can find a way that benefits both parties, which we'll go into shortly, then it can very much be a great strategy. Because again, it's like, it's using other money, it's different ways of growing wealth than having cash, which a lot of us don't have access to. And what about you, DJ? I mean, in terms of like your secondary lending, I know we touched on you having a scenario with your dad in place. Do you want to kind of like jump into some of the finer details?
So I did look into the sort of arrangement that you had with your mum, and sort of, the appetite on my parents' side for that. And then, I looked at the other sort of, secondary lending sort of route, and had some candid chats with mostly my dad about that one. So like I said, sort of mentioned in the previous podcast, I did manage to save the majority of my 20% that I needed. And then I got, that sort of lending arrangement with my dad, but that was also treated, and still is, servicing it now, a secondary sort of mortgage, right? So it's all contracted up. He was able to provide the remaining deposit, but it was all put into a contract with a schedule against it in terms of repayments I'm expected to pay on a monthly basis at this point, and also the additional interest incurred. So it truly is like a secondary mortgage. But for me, I weighed up my options, and that for me I was the most comfortable with that when I was looking in terms of my income and what that was projected to become over time as well. So my comfort level with that. So it's all dependent on your own scenario, right?
And also, I guess there's some leniency in being able to borrow from a family member, and that, they're not going to act like a bank and take your house away.
No.
Sorry, I've worked in banking for a long time, and I just realised that was such a dig.
No, that wasn't, Dad was not going to do that, but he, it depends on the nature of your relationship, right? Like, he made it very clear. Being fully frank, my dad is a lawyer, and he operates in that way, even when it comes to these familial business relationships, which I really appreciate. I've learned a hell of a lot.
I think that's actually what's really been thrown into Slice as well, is that background that I've had in law, and feeling like, even where there is emotion involved and you're partaking in a transaction with family or friends, it's more important that you have those legal agreements in place, and that's what the platform supports with. And it just means that you avoid that conflict down the line. So we'll get into some detail around what some of those legal arrangements are and the benefits of that. But it's very obvious that that you can actually avoid conflict by knowing exactly how you're going to manage that.
Right.
When you kind of went into the interest rates of that second arrangement, how did you guys get into that? Because I know that you can benchmark that, I'm assuming, against some other rate that you're seeing, or you know, how did you guys make that decision?
Well, fortunately, when we did the arrangement, when I bought as well, the rates were pretty low, and we did have an agreement that they would stay at that rate in terms of the repayments I owed him, despite what could come in the future. Right now we're undergoing inflation, so rates have gone up quite a bit.
To be fair, though,
we made
you
some little terms and
effectively
conditions for us.
fixed, kind of, you know?
It was an basically forever fixed scenario, which is very like, it's definitely a luxury on my end, but I just made sure that I negotiated that as best I could with my dad and have those really frank and honest chats about how things change over time, but what I'm comfortable and able to service. And
and we've kind of like organically found our way to benefits there, though, where with your dad, he's obviously receiving some interest on that lending, so that's kind of a benefit that you've negotiated and he's comfortable with and you're comfortable with. So I think that's the important thing when you think about doing that with others, I guess, around your different lending structures, or however it is that you're getting that support. If they're not getting an equity share, so if you're not purchasing, you know, with your partner and then owning 60-40 or 50-50 or whatever it is, and then contributing those amounts, then what are those benefits? Because obviously there's the benefit of owning an equity share and the profit that relates to that over time. But in your case, it was interest earned on that lending. And then I guess to give another example, in my case, when I removed the guarantee, I looked at the value of the house that enabled me to remove the guarantee. So basically the value of the house went up so much so that I was able to find 20% and basically refinance based on the 20% value in the house, and therefore remove my mum's guarantee. And so I did that as soon as possible to obviously reduce the risk of the bank coming for her and her property if I failed to make repayments. But obviously I plan to, you know, have a salary and hope that things will go well, but you want to plan for that worst case. So and in doing that, I think it moved up to somewhere in the you know, close to the 1 mil. I said I bought it around the 800 mark, so it did pretty well there over a short period of time. And I think it's interesting as well, just I'll side note that, but where you can look in different areas and you don't have to necessarily intend to live there in your first home. Some places do have, you know, really high yields in terms of a yield is like receiving good rent back on that property. And also can perform well in terms of, you know, equity, because maybe there's not as many houses in a given area or what have you. So Raglan has actually done really well for me in that way.
So that's a really good point you brought up just now in terms of when you're buying your Raglan property and going with your mum on that. So what were the benefits that your mum received, you know, going in with you? So
as I was saying about that being quite high risk, I wanted to be able to provide some reward, and I guess in the same way as you, you know, provide some benefit back to our parents. So in my case, because she didn't actually put up cash, but she was taking on a risk limited to, you know, 10% of the property value, for ease we'll say it's that. Then what I did is I gave 10% of the uplift. So as I removed the guarantee when it moved into the 900,000s, I gave the 10% of the increase in value from when I purchased and when I was able to remove the guarantee. So that ended up being around 20 grand, which I been paying off. So I think it's important to understand that you need to find something that works for both parties. If you're lucky enough to actually own the house outright, as we still sort of did, like we didn't have anyone else on the title, then what is the different benefit that you're going to provide? But also, you know, having them to stay, that could be, you know, it's a soft benefit, but, you know, them having their own space when they're there, if there's a spare room. What kind of benefits can you provide if you're doing something different, but also if you are going in 50-50, 60-40, or any other arrangement, how is each party going to benefit from that? Are you both going to be living in the property, or is one going to live in the property and therefore they're going to pay rent and then the rest of the mortgage is going to be shared? You've got to kind of negotiate and work out based on your contributions, what benefit are you receiving?
So your mum basically got another batch in Raglan, really is what you're saying.
I'm like, you can use it whenever you want. Not quite true, because I have tenants in there.
Joe loves surfing
borders
now.
in there.
Surfing in Raglan.
But she did definitely come and stay. And over the long term, when it's a batch, and then definitely, Mum, definitely.
So just going back to some of the schemes that are available out there when you are purchasing a property, like NZ Housing and Kāinga Ora. Can you give us a little background as to how those schemes work exactly? Let's start off with NZ Housing as the first one.
Yeah, great. I mean, essentially, if you can't go on with someone else, these schemes are also available to you. But actually, it might be an and, not just an or. You might be able to get help from family and also get help from one of these schemes. But with NZ Housing, there's a few kind of key criterias, but they can support you by kind of going into that property with you. Or kind of supporting with your deposit if you have lower income. So you do need to be a New Zealand citizen, and you have to be a first home buyer. You have to have at least one person working full time. And they do look at how your kind of debt looks and how manageable that is. And they also look at your income. So there is a threshold for the household of 65,000 to 100,000. So you have to sort of fit within that to be eligible for their support. But you can definitely learn more on their website, and also we talk about them on the Slice platform as well.
Nice. So what about the second one, Kāinga Ora?
Yeah, so Kāinga Ora, you either have to have $95,000 or less if you're single, and $150,000 or less if there's two of you. Right. So these are quite high, but also often you might be, if you can service a loan, often you actually do need to have more than that. So it really depends on your circumstances, but if you are eligible, it's a great thing to consider. They can go in with you as a co-owner as well, so they will literally be a tenant in common on the title with you, in the same way that you and I would be if we both contributed 50%.
Sure.
And then you pay them out. I believe it's over a 25-year period, so it's sort of like a second loan there again. So they become your kind of co-owner in that sense.
Right.
So it's really good to get an understanding of these different schemes that might be available to you. It depends very much on your circumstances and how much income your household's making. But they are doing some great things in terms of helping people in those kind of income thresholds in. I guess I would say that it's worth exploring each kind of possibility. If you can go in with a family member, that's amazing, and often you'll get the most preferential kind of rates, or in doing so. But if you fit within that income bracket, that actually might be a really valid opportunity. Another lender that I'd like to raise is YouOwn. So they do secondary lending as well, but they aren't fixated on kind of your income bracket. You can be earning more than that, and then they can still provide you a secondary loan if you don't have someone to go in with, or someone in mind. Right. So there's lots of different options there, but
I haven't heard of YouOwn.
Yeah. So I know Nigel, as we've been in the home ownership and kind of helping with alternative lending. Come across him, and he's a great help as well. And I think what's important though is there's all these different opportunities. You have to work out based on your circumstances by engaging and kind of researching your options, what might be the best path for you. And you really do need to understand the legals and get those agreements clear, so that with these kind of alternative lending relationships, you make sure that you've got a good deal, and you're going to be able to comfortably deal with that over the long term, because some of these agreements are long lasting, like 25 years it might take you to repay NZ Housing Foundation or Kāinga Ora or whatever the structure might be. So super key that you get an understanding around those agreements, which our platform does help with as well. There's lots of opportunities out there, and it's great to see that there are some kind of government funded bodies doing things.
And I feel like they're trying to build on those too, right? They actually are increasing. I've just heard in the news certain grants increasing in size a little
definitely.
bit. It's nice to hear.
It's just the challenges that a complex, arrangement. So
Sure.
hopefully this podcast can help you understand what some of those options are, and then the platform can help you kind of get a feel for what that arrangement and agreement's going to look like before you engage with some of those partners.
Yeah.
So we do work closely with a lot of them, and we'll hopefully work with Kayanga Order and others over as we continue to expand. Yeah, so it really is about understanding the legal relationship between those parties and how you're going to manage that financial transaction over the long term.
What are your obligations?
Yeah.
When you sign on the dotted line,
what
are you accountable to?
Yeah,
really?
but there's I guess the takeaway from that session is what are the benefits or this episode, not session, but what a Sunday session it is.
Like
it's Sunday actually. We're probably, my mind's rolling into the
have a beer right after this. Can't wait.
But it is sort of what benefits are the other party going to get, and so if that's a family member or a friend negotiating that, thinking what are the benefits that the alternative lender or body are going to get as well is as important, if not more, because they've obviously worked that out and they're kind of going to give you the terms. So that's sort of a you own and NZ Housing and a Kayanga Order, understanding the benefits that they're getting and therefore how you're providing to that benefit and whether or not that's appropriate for you. So I think there's lots of opportunities in terms of building up that deposit and getting support to get in there. You just need to explore that first and then really understand what that means for your ability to make repayments and to maintain as much equity of the home as you can as well.
No, lots of really good nuggets in there. I'm looking forward to diving into the next one, which is talking a bit more about the finance elements and what a broker is, what do they do, what are they about, after hearing about these schemes. So thanks Amy, that was great.
Thank you for joining our community. Buying property isn't easy, but listening in will get you one step closer on your journey. Please leave an Apple or Spotify review and provide feedback so we can improve your experience. Join our Facebook group, A Safe Space to Learn Together, or follow us on Instagram at @slicetobuy. If you have any questions or topics you would like us to touch on, you can email us at hello@slicetobuy.com. A quick reminder, Slice the podcast does not provide personalised investment advice. We are not acting as financial advisors or taking into account your circumstances. To get personalised advice, join us at slicetobuy.com and engage with our partners who can act as your financial advisor or lawyer and support you with your specific needs.